If you watch just one investing video this year, make it this one, because I'm handing you a portfolio you can set up in 5 minutes, then ignore 4 years without losing sleep. And yes, I'll give you the exact percentages, but not yet, because if you skip the logic, you'll panic at the first dip and blow up the whole plan. By the end, you'll have 3 versions of the same simple strategy: one for growth, one for balance, and one for preserving wealth while still keeping upside. Stay with me, because the last recipe is the one that protects you when life gets expensive, and it's also the one most people ignore until it's too late. Quick favor before we start. Tap like if you want more simple math-first investing. And tell me in the comments what's your timeline. 5 years, 10 years, or 20 plus. Now, here's the big idea. Most people don't fail because they pick the wrong fund. They fail because they pick a plan they can't stick with when the market gets loud. So today, we're building a portfolio that's boring to manage but exciting to watch over time, because it keeps you invested through the messy parts that usually shake people out. I'm not a financial advisor. This isn't financial advice, and you should do your own research. What I am is obsessed with simple systems that regular people actually follow. This is also a no hero moves video. No secret options tricks, no day trading, no 10-step spreadsheet ritual. Just a clean ETF stack you can run on autopilot. And if you're starting small, good. Small is how you prove the habit. The habit comes first, because the market doesn't reward motivation, it rewards consistency. Here's the rule that will make this work. You're allowed to be wrong about the news, wrong about the economy, and wrong about the next crashes, long as your system is consistent. That's why we're using broad ETFs, not individual stocks. Broad ETFs are like hiring a whole team instead of betting your retirement on one superstar staying healthy forever. We're going to cover 4 pieces: a foundation, a growth engine, a stability and income piece, and a momentum booster that can tilt you toward what's working without you guessing. Then, I'll show you 3 percentage recipes, plus the single rebalancing habit that keeps the whole thing from drifting into a one-way tech bet at the worst possible time. At the end, I'll also give you a 1-sentence rule for when to add bonds or international later, so you don't feel like you're missing something important. Before we choose the 4 funds, let's talk about what we're not doing, because what you exclude is just as important as what you include, especially when you're keeping it simple. First, bonds. Bonds can absolutely belong in a portfolio. But for this specific setup, we're not using a bond ETF as the main safety layer, and I'll explain why. Bonds are supposed to be the shock absorber. The problem is, sometimes the shock absorber doesn't absorb much, and people learn that only after they needed the protection. Cash isn't a return machine, but it's a seatbelt. A cash buffer keeps you from selling investments at the worst moment just to pay bills or handle surprises. Instead, we'll build our safer layer using stocks that behave differently from the high-growth crowd, plus a cash buffer rule that matters more than people think. Second, international stock ETFs. I'm not anti-international, I'm pro-simplicity. Many global companies already earn money all over the world, even if the ticker is domestic. If you've heard the term home bias, that's the argument for holding more domestic stocks than global theory suggests. Simplicity is a cousin of home bias, and that's okay. International funds can help with diversification, and some years they outperform, but if your goal is a set tan-forgetit starter portfolio, you can keep the first version tighter. If you love global exposure, add it later as a 5th slice. Today is about getting you invested with a plan you understand, not building the perfect academic model. Now let's build the 4 ETF stack, starting with the foundation, because if the base is shaky, the rest doesn't matter, and you'll feel it every time headlines get dramatic. The foundation is a broad market ETF that tracks the biggest companies, spreads risk across sectors, and quietly replaces losers with winners over time without you lifting a finger. For most people, that means an S&P 500 ETF like VU or SPY. Different wrappers, same basic mission, own a slice of the engine room of the market. You could also use a total market ETF instead of the S&P 500. The difference isn't life or death. The real win is owning a broad basket and adding for a long time. This fund is your default setting. When you're not sure what to do, you add here. When you're scared, you add here. When you're busy, you add here. Because it's not trying to be clever, it's trying to be comprehensive. And comprehensive beats clever when your real enemy is quitting at the wrong time. Now, we add a growth engine. This is the piece that can run hotter, swing wider, and potentially pull your long-term results up if you can tolerate the volatility. A classic choice is a NASDAQ 100 ETF like QQQM. It's more concentrated and more tech-tilted, so it can soar in strong growth cycles and drop harder in ugly ones. Think of it like a turbocharger. It can help you accelerate, but if you floor it on ice, you'll spin out. That's why the percentage matters, and we'll dial it in later. Next, we need the stability and income piece. Not no risk, not guaranteed, just a different flavor of equity that often behaves better when growth is out of favor. A popular option here is SCHD, a dividend-focused value-leaning ETF. It tends to hold more established companies and can deliver cash flow that helps investors stay calm. Dividends don't magically make you rich, but they can do something powerful. They give you a reason to hold when prices are down, because the portfolio is still paying you. This piece is also your counterweight. When the market is obsessed with the hottest story, this slice keeps you owning the boring businesses people still use in real life. Notice, we're not picking a single AI ETF or a narrow sector fund. Those can be exciting, but excitement is usually the tax you pay for overconfidence and bad timing. Now, for the most interesting piece, the momentum booster. Momentum sounds like hype, but the concept is simple stocks that have been leading recently often keep leading for a while. An ETF like SBMO tilts toward S&P 500 companies with stronger recent performance, and it refreshes that list on a schedule, so you're not stuck holding yesterday's winners forever. This isn't magic, and it can underperform in choppy markets. But as a controlled slice, it can add a trend-following effect without you trying to time entries manually. So we've got 4 roles: broad foundation, growth turbo, stability and income, and momentum tilt. The reason this works is the roles don't all shine at the same time. Here's the psychological trick. Each slice gives you a different reason to stay. One says own everything, one says grow, one says get paid, and one says follow strength. When growth is on fire, your turbo and momentum slices can do heavy lifting. When growth stumbles, your broad base and your dividend value slice can help soften the experience. Notice what I didn't say. I didn't say you'll never have down years. You will. The goal is to build something you'll keep funding through down years. Because the real cheat code isn't the perfect ETF. It's having a plan you keep buying when you don't feel like buying. And that takes structure, not willpower. So here's the structure. You contribute on a schedule, you rebalance on a schedule, and you ignore everything else. No emergency tweaks. No, this time is different. Panic trades. Let's talk contributions. Weekly or bi-weekly beats random. Even small amounts count, because consistency creates momentum in your behavior before it creates momentum in your account. If you can automate it, automate it. Autopilot is the closest thing investing has to a superpower, because it turns your plan into a habit instead of a decision. Now, rebalancing this is the boring move that saves you from yourself. When one slice runs too hot, it grows into a bigger bet than you intended. So you pick a simple rule. Once or twice a year, you bring the percentages back to target. That forces you to trim what got expensive and add to what got ignored. If you want the simplest rule, here it is. Rebalance on your birthday and one other date you'll remember. No constant tinkering, just 2 calendar pings a year. Now we're ready for the 3% recipes. But first, I want you to choose one thing. Your risk lever. In this plan, your risk lever is the growth slice. Higher growth percentage means more upside potential and more gut check moments. Lower growth percentage means smoother rides, but you might feel FOMO in roaring bull markets. So when you hear these recipes, don't ask which one is best. Ask which one you can follow when the market drops and your group chat starts predicting the end of everything. Recipe 1 is for the long runway investor steady job, far from needing the money, and emotionally able to watch bigger swings without hitting the sell button. One example allocation: 35% S&P 500 foundation, 25% momentum, 25% growth, and 15% dividend value for ballast. That mix leans forward, but it still has a stabilizer. And your real safety isn't a bond fund. Here it's having an emergency fund so you're not forced to sell in a drawdown. For this first profile, a cash buffer of 3 to 6 months of essential expenses can be the difference between staying invested and becoming a cautionary tale. Recipe 2 is for the middle runway investor, maybe around a decade out, more focused on protecting progress while still getting meaningful upside. A balanced example: 30% S&P 500 foundation, 20% growth, 25% momentum, and 25% dividend value. This shifts weight towards stability without giving up the engines completely. You still participate when markets run, but you're less dependent on one hot sector staying hot. For this profile, I like a bigger cash buffer, often closer to a year of essential expenses, because stability is about behavior as much as it's about asset selection. Recipe 3 is for the investor already pulling income retired or close enough that a deep drawdown would change lifestyle choices, not just feelings. A conservative example: 45% dividend value, 30% S&P 500 foundation, 15% momentum, and 10% growth. You'll notice we didn't delete growth, we just put it in a controlled corner. That way you still have oxygen for long retirements without betting the farm on the turbo slice. For this profile, the cash buffer rule gets serious. Think in years, not months, because selling after a crash is where retirements go from math problems to life problems. And yes, some retirees will also use short-term treasuries or bonds. That's totally reasonable. The point today is the simple equity core and the behavior around it. Now, I want to show you a quick way to pick your recipe without overthinking. Ask yourself one question. If your portfolio dropped 20%, what would you do next? If your honest answer is, I'd buy more, you're closer to recipe 1. If your answer is, I'd hold and feel sick, recipe 2. If it's, I'd need cash, recipe 3. That's not a personality test, that's a planning test. Your plan should match your real behavior, not your fantasy behavior. When markets are calm and everyone feels brilliant, let's make this practical. With a simple, hypothetical example, no promises, no predictions, just mechanics. Say you invest a fixed amount every week for 5 years. In strong years, your growth and momentum slices might sprint ahead. In weak years, your dividend value slice may look less exciting, but it can keep you invested. Now imagine you never rebalance. The winners keep growing into a monster position that feels good until the monster becomes the thing that crashes hardest. Rebalancing is how you quietly take profit without trying to time anything. You're not calling tops, you're just returning to your plan like a thermostat returning to its setting. Here's another practical trick. Use new contributions for rebalancing first. If growth ran hot, you aim new money at the lagging slices until the percentages drift back. That way, you rebalance with cash flow instead of selling, which can feel simpler and may help you avoid tax headaches in a taxable account. Speaking of accounts, put the right things in the right buckets when you can. In taxable accounts, you want to be mindful of dividends and realized gains. In retirement accounts, you usually have more flexibility to rebalance without triggering taxes. The exact details depend on your situation, so do your homework. Also, watch fees. ETFs are cheap, but cheap isn't free. Over decades, small fee differences add up. You're not chasing the lowest fee at any cost, just avoiding silly overpaying. Now, let's address the 2 objections I know are coming. Objection 1. What if tech collapses? Answer. Objection 2. What if value stays boring for years? Answer. That's why value isn't your entire identity. You own the broad market, you own growth, and you tilt with momentum. This is the point of the stack. You don't need to be right about which style wins next. You just need to stay invested while styles rotate like seasons. Here's a trap to avoid: constantly swapping ETFs because a chart looks better this month. That's not strategy. That's anxiety with a brokerage login. If you want a rule, use this one. You're allowed to change your allocation only after a full year on the plan, and only if your life timeline changed, not your mood. Another trap: starting too complicated. If you've been stuck on the sidelines, you don't need 8 funds. You need 1 decision today and a second decision later. So if 4 feels like too much, start with the foundation ETF only. Then, after 3 months of consistent contributions, add 1 slice at a time until you reach the full stack. That gradual build keeps you from freezing, and it teaches you how each part behaves. Understanding creates patience, and patience is a profit center in disguise. Now, I promised something at the end, so here it is, the 1-page portfolio card. Write down your 4 tickers, your percentages, your contribution schedule, and to rebalance dates. Keep it somewhere you'll actually see it: notes app, printed paper, whatever. When markets get noisy, you don't need a new idea. You need your old plan, clearly written. If you want, I'll make a follow-up video where we build that card for different ages and incomes. Using the same 4-fund structure, comment the word card if you'd watch that. And if you got value today, share this with one person who keeps saying they'll start investing soon. Soon becomes never until a simple plan makes starting feel easy. Let me recap in one breath. Foundation S&P 500, growth NASDAQ style, stability and income dividend value, and a momentum tilt. Then choose one of 3 recipes based on your timeline. Automate contributions, rebalance once or twice a year, keep a real cash buffer, and ignore the drama. That's the whole strategy, simple enough to follow, strong enough to matter. Next time, we'll talk about the biggest mistake people make with set and forget. Forgetting the forget part and turning it into a hobby. Hit subscribe so you don't miss that one.